Fundamental investing can get really complex really quick, and that's because changes in the balance sheet and income statement do not necessarily have linear effects when valuing a company. In fact, the change of a single variable can affect a plethora of other variables, metrics, and conclusions one can make about the health or status of a company. And this can become a problem when trying to implement a value investing strategy. Investments that look cheap in one metric can look expensive using a different metric. Adding leverage to a firm too can distort a company's outlook, as what can look like healthy earnings can just be debt propping up earnings during a bull run cycle. Cash, on the other hand, is generally known as an amazing resource that companies can deploy opportunistically and can often have the opposite effect of leverage, as excluding cash can make companies look worse off than they actually are. So how can value investors take advantage of these dynamics to target companies that, though hated by the market, could be well positioned to take advantage of future opportunities? In the paper Valuation Multiples, What They Miss, Why They Differ, and the Link to Fundamentals, the authors explore the effects of cash in valuation metrics. As an example, they point to two companies with similar PEs but wildly different enterprise multiples. And the enterprise multiple is a valuation metric that compares the total enterprise value, or the market cap of equity and debt minus cash, to EBITDA or EBIT, which is the operating income of a firm. Well, in early 2024, Walmart and Apple both had a forward earnings PE of approximately 25. Now ask yourself, which company would you rather own for the long term based on pricing power, innovation, and quality? I think the general consensus would point to Apple being the potentially superior company, regardless of valuation. And yet, both of these have the same forward PE. So what's the deal here? Is the PE ratio broken? Why would two companies with completely different market outlooks have similar valuations? Well, let's take a closer look. When taking into consideration enterprise multiples, Walmart had an EV to EBITDA reading of 13.3, while Apple's was 20.1. So one can see that by merely changing the measuring stick, the story too starts to shift. The authors attribute part of this discrepancy between the PE and enterprise multiples to Apple's net cash position compared to Walmart's net debt position, Apple's higher profitability based on EBIT margins, and lower effective tax rate. All of these were contributing to what is most likely a wrong read on the company's true valuation using price to earnings multiples. The authors come to the conclusion that in most cases, the multiples of PE and EV to EBITDA provide a similar signal. But there can be cases where two companies have similar PEs and dissimilar EV to EBITDA multiples, or dissimilar PEs and similar EV to EBITDA multiples. These differences are generally attributable to differences in underlying profitability, capital structure, or tax rates. As you can see, enterprise multiples have a natural tendency to reveal quality measures as compared to something like PE. Specifically, going back to examining the effect that cash has on enterprise multiple valuations, one can see how a combination of cash and debt can greatly affect the company's valuation prospects. Let's dig deeper. We'll start with two companies that have the same operating earnings, equity, and debt market cap, and cash positioning. If we were to then decrease debt and increase cash for company A, and increase debt and decrease cash for company B, and holding everything else constant, the total enterprise value of company A would decrease and the total enterprise value of B would increase. Though this doesn't reveal much in it by itself, by comparing it to the operating earnings, which is the same for both companies, one can see that company A is a much more attractive investment option from both a relative valuation and quality standpoint. All in all, by ignoring leverage and cash positioning, investors may be getting a distorted read on their investment prospects, which could obviously hinder them from achieving the best possible results. In fact, this is what the authors find. There is some evidence that EV to EBITDA multiples outperform other multiples, including PE. Specifically, buying stocks with low EV to EBITDA multiples generates higher excess returns than other metrics. Empirically, using enterprise multiples has been the better bet according to this paper. And I think this all makes intuitive sense. What else should an investor hope but to invest in quality companies selling for a bargain price, ideally with low leverage and in a healthy position. So, if you're a value investor, it's great to get a bargain, but ask yourself, what is the best way to measure what is a bargain and what is not? That's it for today. Thank you so much for watching. If you enjoyed this video, make sure to like and subscribe. More importantly, share this with a friend. Also, make sure to head to alphaarchitect.com/subscribe, and there make sure to subscribe to the blog where you can find more educational resources like this one. Lastly, make sure to follow me on TikTok at Coffee Hour with Jose. I'll see you next time.